Kia ora ana tātou katoa, tēnā koutou katoa. Welcome everyone. I'm very proud to be here today to present our financial stability report. I'm joined today with Deputy Governor Jeff Baskand and the manager of our financial analysis team, Chris McDonald. Before I get into the report, I just do want to express our thanks and our understandings for all of those folk who may be coming in from the Waikato, Auckland or Northland region. Thank you very much for your courage, your tenacity. We totally understand how stressful the situation is for you. Our very best wishes with you. And in fact, the COVID challenge will be a key part of what we talk about today. For anyone else, please do get vaccinated. We need to shift into our New Zealand vaccinated environment as quickly as we can. Today, I am pleased to state that our financial system is proving resilient to the challenges in particular presented by COVID-19. This should be reassuring to us all, given the very uncharted waters that we are currently in, but importantly, what are ahead of us. We need our financial institutions to be robust, so it is fantastic that they are proving to be so. The period ahead is one in which financial institutions need to be truly supporting all New Zealanders as we shift from this pandemic period into living with COVID-19, however that manifests itself. There is lots of hard mahi ahead. We need the financial institutions to be involved. I would say that to date, in New Zealand and by design, it has been the government's balance sheet that has taken by far the biggest brunt of the COVID-19 economic shock. Looking forward, this will change. It's going to be household business balance sheets that will need the support of the financial institutions. So again, as we move towards whatever future business as usual looks like, our financial institutions are in a strong position to support and assist all New Zealanders. Internationally, global economic activity has continued to expand, but as we are all aware, this is not without difficulties, in part driven by the challenges of the COVID-19 pandemic. Most obvious has been the heightened global inflation risks, and this comes at a time when asset prices are already stretched. So they will be feeling headwinds from rising global interest rate expectations. In New Zealand, economic activity was back above the initial pre-COVID economic level, but of course this was prior to the more recent Delta outbreak, which is creating significant stress both at a personal level for all of us, but especially for some industries and some regions of the economy, in particular in Auckland. A transition towards living with COVID-19 in the community, as a managed endemic disease is and will change consumer behaviour, and this will affect the viability of businesses going forward. So investment transformation is necessary. Likewise, the supply chain bottlenecks and rising cost pressures we're seeing in the economy are adding to financial stress. As I outlined in a speech yesterday, we are seeing continued strong demand for housing, and we've seen elevated house prices which are above their sustainable level. The further this continues, the higher above sustainable price levels, the more likely there is for a correction, and the larger a correction that could happen. Recent buyers are borrowing more relative to their income, and it may be vulnerable to higher mortgage interest rates or a fall in house prices. Again, I'll emphasise this is around the individuals, the household balance sheet. The financial system as a whole is resilient. While loan-to-value restrictions, our LVR restrictions, have been our main macro-prudential tool to minimise the at-risk parts of bank balance sheets, We are looking to soon consult on around an additional tools or a framework for additional tools around debt servicing restrictions. This is an additional tool we can have to ensure bank balance sheets remain robust. Meanwhile, of course, we expect banks to be more cautious about high mortgage debt to income loans, given the risks of rising interest rates and the challenges for the economy in the period ahead. Banks need to be focusing their attention on supporting businesses beyond just residential mortgage lending, and to ensure their customers are able to grow and transform in coming years. The unpredictable nature of future economic stresses reiterates the importance of the robust financial system that we are seeing at present. The banks are in a strong position, as are insurers, to support their customers going forward. We're encouraged to see that recent large bank stress tests results, which have used a plausible but severe set of economic downturn scenarios, highlight the bank's growing resilience. And this has been especially so given that bank capital levels have been rising. These are the buffers that banks can dig into when times are tough. Our minimum capital requirements for banks will progressively increase from 1 July 2022, but again we're pleased to say that many banks have already moved significantly towards those targets over recent quarters and have done so while remaining very profitable and very active in the economy. In the longer term, understanding and managing the many risks related to the ongoing climate change is going to be critical for New Zealand's financial system. Financial institutions have to be part of the solution, part of the transition to a new lower carbon economy, rather than victims of not moving soon enough. We are working with banks and insurance companies around stress testing for climate change, but these are at early days. We can think about the physical risk of climate change and understand that in a tangible manner, but there are many transitional risks that all business people, members of society have to think about. So we will be talking a lot on that topic and working with the financial institutions and ourselves to make sure we are fit for a low carbon future. I'd encourage everyone to read our financial stability report. It is a thorough document. Thank you, Chris. Here it is. There will be an exam. Please do look at it, and also remember it hasn't come on its own. Everything we've talked about and elaborated on in the Financial Stability Report has supported the analytical note we produced yesterday around house price sustainability and various measures. And of course, it has drawn on our document around the challenges of climate change and what we're doing. And just before we go to questions, I'll remind people that we are back very soon with our monetary policy statement towards the end of November. And so we will need to be a bit cautious around monetary policy discussions. Kia ora, me taki ma'ata. We are open for questions. Thank you.
Stephen Wright from the Wall Street Journal will start with you.
Kia ora, Adrian, and thank you for your time. As you might be aware, the unemployment rate in the third quarter fell to 3.4%, which is a record low. The bank's already perceived as being falling behind the inflation curve in terms of its monetary response. Do you see this spectacular unemployment figure adding to the risks that inflation is going to get baked in at a higher level?
Thank you, Stephen. Could I ask the camera if we could have the whole panel rather than just myself, because there are some very wise and better dressed people here with me today. Thank you. First, we're not here to talk about monetary policy and what it does or doesn't mean for future interest rate changes, so I just emphasise that. The second part, the labour market data, or data in total, is highly volatile at present globally. But the underlying trends are very clear. The COVID 19 economic shock has had a significant impact on the supply side of the economy as well as the demand. So we are seeing strong demand for all resources, but also at a time when the ability to meet that demand is challenged. So we have talked very clearly, and I would have to say more proactively than what you suggested in that question, being one of, I think, only two central banks who have actually finished QE, have risen, lifted their interest rates. So as part of a continued story, but the data is highly volatile.
Next question from Bernard Hickey at the Kaka. And then Ainsley.
Thank you. Governor, there's mention in the Financial Stability Report about a bank stress test that was done for this year, and that the results are going to come out in an analytical paper later on. The suggestion in the report is that there was a good result, but could you give us a bit more flavour and detail on how that stress test went and how much the banks could cope with?
We will be releasing a full paper on that before the end of the month, Bernard. So, look, the short story is, yes, that with the rising capital levels and the scenarios that we conducted, banks were resilient. And that's reassuring. I mean, that's what we absolutely want to see. And the purpose of raising capital levels is they can withstand severe shocks. So I don't know, Chris, is there anything you'd want to add, because we are going to publish it?
Yeah, just to give you a flavour of the scenario that we were looking at there, was it had kind of much higher unemployment, kind of getting up around the 12% level, and house price falls of kind of 39, 40%. So pretty severe shock. And I think the big takeout that we got from that piece of work has been that with the banks increasing their capital positions, that has increased their resilience.
Given that, why did the Reserve Bank tighten their LVRs, and also why is it consulting about a DTI, given that the banking system's quite strong and the suggestion is it could handle house price drops without too much pain?
Well, the LVRs are clearly intended to lean against what we see as rising risk. So the stress test is on current portfolio of lending and current capital levels, but we were seeing more of the new lending going at high debt to income and high LVR levels, particularly for first home buyers, but in general for new borrowers. And so what we're doing is avoiding a significant accumulation of risk by leaning against it earlier than waiting until that risk is in there, and then you get the downturn. And of course, what happens and why we apply macroprudential policy is if the whole lot of households get under a lot of stress and you get an economic shock as well, unemployment can rise, you get dynamics that are all negative and they spiral down, and that becomes a mounting problem in the financial system over time. So we're trying to make sure that we avoid that negative cycle. Question of debt servicing restrictions, well, that will be obviously consulted on, and have to have a cost-benefit analysis of how much we need those. It will depend upon the risks at the time, whether risks are mounting or whether we've managed to maintain, and banks have been prudent enough to keep lending at a prudent level. If risks are low, as sort of you're implying, then they may not be needed. If they're rising, then they would be.
Thank you.
Next question, Ainsley Thompson, and then Jenny.
Hello, Governor. The report discusses the transition from COVID being a pandemic to becoming endemic in the community, and the changes that could lead to in consumer behaviour. Could you expand a bit on those changes and the risks that you see them posing?
Yeah, thank you, and good question. And we are certainly far from having a monopoly on wisdom in this place. What we're referring to is first and foremost that people are far more cautious about social interaction. We're seeing internationally, even once we have highly vaccinated populations released back into the streets, you have ongoing periods of disruption when various lockdowns may have to occur. But also in the absence of that, you're seeing people far less willing to return to downtown centres, financial centres, low occupancy rates across previous very full office blocks. These are common stories globally, and anyone who's relying on foot traffic or high frequency visits will not be seeing them. Now, that short-term impact of the virus will be a more permanent feature, but it's also accelerating, I would say, the longer-term issue around shopping online and the virtual economy. So shops and retail centres have been far more centres for your tactile experience of trying something on or tasting something. It's then delivered to your door. So these are long-term structural changes that are happening through time. Service sectors that can't deliver their products online are having to think about where are they going to be better located through time, and where is this foot traffic, where is this intersection. So the more dense urban dwelling is, the more likely that these types of services are back in suburbs or outer regions, not necessarily the inner cities. We're seeing the reflection come through around commercial property, whether it's across that sector. You're seeing wholesale distribution units growing rapidly, doing extremely well. You're seeing retail commercial areas struggling. And so it's these types of trends and behaviours you're seeing. Note I've only talked about retailing. I haven't even gone near tourism or near consumer behaviours around where they want to buy their products from, particularly if you overlay climate change and carbon footprint issues.
Thanks. And next question, Jenny Ruth from Business Desk. I think you're on mute, Jenny. Sorry.
Sorry, can you hear me now?
There you go.
I just said, going back to Bernard's question, can you tell us what the lowest level of capital any of the banks reached during the stress testing?
No, I can't.
We can't. And can I also just remind people, it's coming. We'll be publishing that document.
Well,
We're here to talk about what we've published.
But you know the results now. Why can't you tell us now?
I'm not sitting them with exactly at my hand, that's why.
Next question. Have we got anyone else? Still Tamsin Parker.
Can you hear me? Sorry.
We'll go Eric.
Okay, thank you very much.
Yeah, hi Adrian. I just wanted to ask, do you think the banks are doing enough to support businesses? You note in the report that as businesses churn through their cash buffers, that we're likely to see more stress in the business sector. So, do you think banks need to be doing more, or, does there need to be, say, the mortgage deferral scheme brought back to support those businesses that may be feeling future stress?
I believe that the banks have enormous work ahead of them, and they've had it good to date. So they've been extremely busy operationally around making sure that they can continue to provide services under the stresses that all other businesses have been facing. But as I mentioned, it's been the government balance sheet that has primarily borne the brunt. And you're seeing that through the current reporting season. Bank capital positions, bank profitability, and the write-back of previous non-performing loans is incredibly robust in terms of record levels. That should put them in very strong position to assist going forward. The government balance sheet, the financial sector balance sheet, household balance sheets, corporate balance sheets all need to play a role. And I would say over the next 2 years, it's going to be corporate and household balance sheets that are going to really need the support of the bank financial institution balance sheets. Governments internationally cannot continue to be the only stop in only bus stop. This is why banks hold capital. This is why they do their business. It's strongly in their interest to make sure they are supporting businesses through transition back into economic growth, because that is their future revenue. To date, bank profitability has primarily in New Zealand been driven by residential mortgage lending. We're seeing some growth back in business lending, but it's still below the level of pre-COVID, and we're seeing it being very selective in areas of growth, not necessarily in areas that need ongoing support through this period. So that is, that's stark. We talked about courage. We need to see it continue on the way through.
Our next question, Eric Frickberg. You can turn your camera on too, please, Eric. I don't think he's there. I'll go to Janae, interest.
Hi, everyone. Governor, I'm just wondering, how does the Reserve Bank weigh up the financial stability risks in the near term versus those in the longer term? And my question refers particularly to first-home buyers. So while there is an argument that first-home buyers or recent entrants to the housing market are vulnerable at the moment to rising interest rates, there is also arguably a financial stability risk in the future if a cohort of people cannot get into the housing market because lending restrictions are too tight. It means that when they reach retirement, they might still be renting or still have quite high mortgages. I'm just wondering, how do you balance financial stability risks now versus looking ahead?
Thank you, and absolutely great question. Our purpose is not only just for financial stability today, but now and ongoing through the future. So we see our actions of what we've done as being completely consistent with managing today and the future. You do not want to put people, you don't want to have financial institutions putting themselves at risk or households at risk through lending that might be unsustainable through time. So that's a bit around the now. Likewise, if that unsustainable lending is leading to excessive asset price changes, that creates instability in itself. If we got things right, and by the way, that still is a very broad area, then the scenarios you're talking about might pan out something like, it's not always housing investment as my only nest egg for financial security. I may have more future choices around buying versus renting, and if I buy, those house prices may be more sustainable, i.e. more consistent with my income and my ability to service it through time. What we're seeing today are neither of those. A high concentration in housing and housing investment as a retirement vehicle, and buying houses at prices that we we have analysed as being unsustainable. So, it's about seeing house prices evolve more related to the underlying economic fundamentals, which are the incomes of the people you're talking about.
Right, next question, Matthew Brockett, then we'll go to Bernard.
Hi, thank you. Just wondering if the COVID outbreak has obviously lasted a lot longer than many people initially thought, the lockdown in Auckland and so on. I'm wondering whether you see a risk of a recession, a second contraction in the fourth quarter, notwithstanding the astounding labour market stats we saw today.
Without doubt, the GDP figures are becoming increasingly difficult to understand and relate to what we actually see out the window. That's an international comment because of the high volatility, variability and changing consumer behaviours. But I will ask Jeff Baskand, his team has been very much on the ground of recent with the financial sector.
Well, I think the Governor's described the patchiness of the economic recovery and story, if you like, and that's a real difficulty in assessing it. There are definitely regions, sectors, businesses that are facing stress, but it would be fair to say that the banking system hasn't seen widespread stress, and so that's one of the inconsistencies in that trying to balance up the perspective on this. That some of the pressures are from firms that maybe aren't big borrowers from the banks. Some of them actually have been holding on to protecting their cash flow positions quite carefully and not needing to go to banks for working capital at this point. So, we're going to have to weigh this up both in a monetary context and a financial stability context. But Governor has also said you're seeing quite a bit of government support going through, wage subsidies and resurgence payments to assist those businesses. So the longer it goes, the more stress will appear. We're all hoping we get through to a wider level of economic freedom, activity in the next month, 6 weeks, I suppose, before Christmas. But we are confident at this point that there aren't significant financial stresses in the system, in the banking system, that would cause us to worry about spillover implications of that. That's the nature of financial stability concerns.
Can I just briefly add that also headline GDP figures aren't that useful in terms of the devil is in the detail. We're still consuming, and also our ability to actually supply is highly challenged, and I'm talking about this globally. So it's going to be the devil in the detail around what are those structures, those components that most matter for when we're setting monetary policy or thinking about financial stability. So it's
and just adding to that, I mean, the fact the unemployment numbers are so good suggests that households themselves are being reasonably well protected. If there is employment, there is still wage income. The number of people on wage subsidy is much lower than it was last year, and so you're right. The activity number itself is only a partial indicator of the health of the economy.
Next question, Bernard Hickey, the Kaka.
Thank you very much. Governor, in this report and in your speech yesterday, you talked about housing supply issues and that the inelastic housing supply was a factor in the housing market. I wondered what the bank was doing itself about looking at capital requirements for new housing loans and also loans to residential property developments, because I noticed from the stats the Reserve Bank puts out that lending from banks to residential property developers has actually fallen over the last 2 or 3 years, despite consent growth at record highs. And I'm trying to work out what the bank itself could do to make the housing supply more flexible through its guidance to banks about how much or whether they lend to people who are building houses.
So I'm going to answer in a very straightforward and short manner, Bernard. It's the supply of space and land. It's not access to capital that has been one of the main constraints and drivers of house price volatility in New Zealand, and especially relative to the rest of the world. So the capital is there, the will is there, the demand is there. It's just, where are we going to build it? And that has been the case up until quite recently. The tide has turned. There is significant new space now available, both in terms of land and in terms of what you can do per area, what you can do on that land. So we are seeing record high consent levels. We're seeing new areas being opened up, and we are going to be going into, I would say, a generational change in urban density. So, the more we can free that supply up, the better, the more supply can respond to the demand. So it's not about capital, it's not about access to capital, it is in part about access to resources to be able to build, but it's mostly about access of where to build.
And just secondly, there's a fantastic chart, figure 2.12 in the report, which talks about what happened to lending and deposit growth to various businesses in the economy during the pandemic, which seems to show that bank lending to pandemic affected industries fell in the last year and a half, while their deposits rose. And the same thing happened for the less pandemic affected industries. And I'm just trying to understand whether that's something you wanted to see, or also just how stressed those industries are if their bank deposit levels have actually increased substantially.
Yeah, so what you are seeing there is in part an outcome of what I've talked about, that it hasn't been bank balance sheets that have borne the significant part of the brunt of the economic COVID-19 challenge. It's been government balance sheets through the various actions they've taken. The second part is you can lead a horse to water, but you can't make them drink. Some of these businesses that have been sitting in severe COVID-19 lockdown scenarios are not going to their bank to borrow more. They are living on their cash reserves and doing other activities to manage financially through it. But from here going forward, as you know, as we emerge as a fully vaccinated nation, go and get vaccinated, as a fully vaccinated nation, then this is where we want banks to be there to support the customers as they consider reopening their businesses on a more permanent basis, and also reinvesting or transitioning into whatever their future businesses will be. It's from here on the mahi starts for the banking sector. The deposit side, that reflects the resilience of the household balance sheets. Deputy Governor Jeff Bascan provided a speech recently which showed that household balance sheets, business balance sheets have been incredibly robust because government balance sheets have been supporting them.
Thank you.
Any more questions?
Coming up to the last one. One more? Or none?
Yeah, can I speak?
Going.
Can you hear me?
One from Eric Frickberg.
All right. I'm sorry, my camera isn't working, but hopefully you can hear my voice. Just two questions briefly. One is on DTIs. Your report indicates that you're starting consultation later this month, and you seem to be very sort of bullish about them, but you don't say that they will happen. Is it still touch and go? Is it still maybe yes, maybe no? That's the first question.
Simple answer to that is we're consulting, and if you're consulting properly, you consult with an open mind.
Okay, thank you. Second question, with regard to the speech yesterday about housing sustainability, there were suggestions as to what the appropriate level of house prices might be, but unless I missed it, I didn't see an actual figure. Is there a figure, and is the suggestion of groups like Demographia that 3 times household income is the optimum level for house prices? Is that something that you have any sympathy for?
So the first question is no, you didn't miss it. We did not put a number there because while we talk about the housing market that is made up of many houses across many regions, there's no single price. So we were providing scalars of I suppose, how separate current aggregate house prices are from an approximate measure of something that could be sustainable. So it's giving you an indication of whether you're north or south of that, and if you're a long way north or south. And at the moment, we are well north of a sustainable price measure. On your 3 to 1 ratio, no sympathy here. I'm not sure what that relates to, but certainly in our document as we go out, we'll be talking about the general frameworks and provide some working examples. In the past, we've provided examples of, I think, a ratio of 6 or 7, depending on residential, commercial, investor, type mortgages.
Yeah, and just to add to the Governor's comments, I mean, in a long-term sense, international interest rates are a lot lower than they were when we had ratios of about 3 to 1 back in the 70s and 80s. So, you know, we've expected to see some increase in the ratio of debt to income above that. You know, so we're playing with different possible calibrations. Behind both of your questions is what would be the risks to the financial system from having it at different places, and it depends a bit on what other measures we've taken, the LVR measures, where interest rates might go, and how far asset prices or house prices are over a sustainable level. So all of those things would come into the calculation or the estimation of what would be a reasonable setting if we proceeded.
Wonderful. Just a closing comment, and it's a thank you to my strong moral support and intellectual guidance partner, Jeff Baskand. Jeff, this is your last financial stability report being delivered in your role as Deputy Governor here at the Reserve Bank. I want to thank you on behalf of all current and future New Zealanders for your wisdom and guidance, and I think I could not think of a better, more thorough, more well-researched document than this financial stability report to leave on, Jeff. So, kia ora.
Thank you.
Thanks, mate. As you can see, he's humble as well. Thank you.
Thank you.